Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address. Disclaimer time. This is where I tell everyone to lighten up. It's just a podcast. Trading is like that roller coaster at the amusement park. Thrilling, unpredictable, and potentially stomach-churning. What works for one person might leave another clutching their hat in the wind. Our hosts and guests, they're awesome, knowledgeable, full of insights, but we're not financial advisors. So don't rush to make any investment decisions based solely on our banter. Always consult with a professional or do your own research. Plus, let's face it, we like to have fun, laugh, enjoy the trading ride together. It's all in the name of good podcasting fun. So remember, take it easy, don't bet the farm, and keep your seatbelts on at all times. Thank you for listening. Hello, everybody, and welcome to the inaugural episode of our newest miniseries, Informal Economics for Traders, featuring the informal economist himself, Eric Mason. And to help out with the questions, I've enlisted Vanta Trading's Mr. Banks, so he can add the perspective of a profitable trader to the mix. Eric, you want to kind of walk us through what we got planned for the miniseries here?
Yeah, absolutely. I certainly won't have as cool of a nickname as Mr. Banks. That's just shadowy and awesome. I love it.
I think it's more Mary Poppins.
That's exactly where it came from.
Yeah, so for the series, I think what we're going to be looking at here is to kind of demystify a lot of economic jargon, economic topics that permeate trading, and honestly permeate every aspect of people's lives. I mean, the beautiful thing about economics, it's ambivalent. It's everywhere. Whether you're buying a car, whether you're trying to figure out what route to take to your job, or in our case, in trading. And the only way to really understand that, and I think we'll cover this a lot in the first episode, is the foundations. But we're going to start with a strong foundation of what is economics and how does it impact people's trading decisions. And we're going to explore that and kind of grow it so that, we want to give the tools so you can analyze financial and economic news as it comes down the pipe. We're looking at several different important rate meetings of the Federal Reserve over the next year, 18 months. That alone, certainly makes it worthy to discuss economics, but we are coming into an election year. We're coming into kind of a little bit of an interesting volatile period in the stock market with some of these renewal of debt. All these things come together to describe trading scenarios, and economics is really the ink that writes trading scenarios in a lot of cases. So I think we're gonna have a lot of fun doing this. This was 100% Kyle's idea, so please send all your hate mail to him for listening to me. But aside that, I mean, we're hoping to do a lot of Q&A. We're hoping to do answer questions directly. As an economist, I think my job, I'm not a smart person. I'm just a translator, except I'm translating a bunch of stuff a lot of people thought of who were a lot smarter than me a long time ago, and applying it to today. So questions are good. Generally, just yelling at me is always a positive way to elicit a response, but it's going to be an informal discussion.
Yeah, if anybody is listening along who has questions, comments, or does want to just share something with us, you can send us messages either by Discord, or you can email us at bandoftraderspodcast@gmail.com, or you can shoot us a message on Twitter. We'll have links for all that stuff in the show notes. But I think after that fantastic introduction, why don't we just give you the microphone and let's kick back and learn some shit.
Yeah, I mean, first off, kicking off, I'm on Twitter too, and I use it professionally, so feel free to tweet horrible things at me because I can't respond. Jump into that cesspool with me.
Am I following you on Twitter?
I hope not. It's horrible.
I think I did. Okay, I think I got it.
Yeah. Feel free to talk smack to me on Twitter, X, whatever we're calling it now. It's great. Yeah, don't Twitter. Make your Twitter professional. Like, don't do that. Like a hack on there, because I am. All right, so we're gonna start with the foundational episode, and economics is a little weird because where does the foundation of economics start? you'll get a lot of people who say like Wealth of Nations with Adam Smith. You'll get a lot of people who say Rousseau's Social Contract. And then you'll get a lot of wrong people who will say Karl Marx and Das Kapital. Because you're incorrect if you think any of that should ever be applied to making any sort of decision. When you have to pawn your pants and rely on aristocratic money to make your point about not needing to pawn your pants and rely on aristocratic money, you're inherently a fraud. God, all right. So we're just going to start real crappy the first 2 minutes. Let's piss everybody off. All right. So I think the best place to start off is kind of humanizing a lot of the economic jargon that we hear. In economists, we love jargon. We love saying, you ever see that meme of like that really overweight guy who never leaves his basement that just is actually spelled really goofy? I swear the guy's an economist.
Yeah, I think I know what you're talking about. Like the nerdy picture?
Yeah, exactly. Just all over Reddit.
Yeah.
That's, I swear the guy's an economist because there's something about us that love acronyms and, all that stuff. So, but I think one of the most important things to start off with is kind of discussing what these macroeconomic indicators are. And I'm going to take a step back real quick and talk about what macroeconomics is. So economics is really split into 2 fields, microeconomics and macroeconomics. There are some economists who will argue and say that there's another field called econometrics, which is just like advanced statistics being applied to economics. That was true probably 25 years ago. Econometrics is now part of both fields. Macroeconomics is a general discussion of how usually national level policies and initiatives affect the economy broadly. It's not really specific to markets themselves. When we start discussing markets, we get into microeconomics. I teach microeconomics at a university, and one of the hardest things I deal with, young people, and I love teaching microeconomics. I love being one of the first people these kids get to talk to. Is microeconomics is very rote. It's basically a form of calculus with some philosophy mixed in, and that makes it really easy for people like me who miss the forest of the trees to really dive into. Macroeconomics is fun because macroeconomics is really a mixture of reality, what you're seeing happen, and this beautiful kernel speculation that renders all this economic education useless. It renders it like trivial as hell. So before I dive into it, I just want to be really clear. Every economist is biased. Like, we're biased by the schools we belong to. And, Kyle and I have had a bunch of conversations over the last year or two.
You're a Dickensian, correct?
Yeah, exactly.
Okay.
So you have a few different schools. You have like classicalists. Those are guys who are like supply and demand. That's all that matters. And they take that and apply it on the national level. And that usually results in like very aggressively libertarian policy where government shouldn't interfere in markets at all. Then you have Keynesian. Now, to be blunt, Keynesian is the first form of macroeconomics. So like classicalism existed. And that was that big, supply and demand trade-off. But John Maynard Keynes was the first guy to be like, hey, let's look at this as an entire policy setup. Look at this as a package. Now, my school is the contrarian. It's the heterodox to, or the opposite of Keynesian. I'm an Austrian economist. So that means...
Austrian, that's right.
Yeah, so that means I think all economists have no idea what they're talking about, including me. And we should just observe what the average person does and be like, that dude knows more about his economy than anybody else knows. And if we sum up all those individual transactions, that's the economy as a whole. So just start this off with me thinking that most of the things I'm going to say, I don't even believe I'm good at.
Okay, all right.
So as we kind of branch into that, I just want to be clear that I'm an Austrian. A lot of my opinions, I'm not a pure Austrian, so I'm not somebody who thinks, don't read Hayek and think it's going to be the same that I'm talking about. I do believe a lot in the man on the spot, but I believe in empowering people. That if you give the average person education, if you're a trader and you're learning and you're a trader and you're examining a company, that I can't sit in an ivory tower and tell you you're wrong. I actually think that you're being rational by investigating, a company. Say you like Boeing a lot, and by investigating Boeing and learning, how MCAS systems works and stuff like that. And that's going to speculate how you trade on it. That knowledge is valuable, and how you accumulate your knowledge makes you more economically efficient. So Austrian relies a lot on kind of empowering individuals to be their own boss, that you don't exist in this superstructure. You don't exist in the structure. The structure is you. And macroeconomics from an Austrian perspective says, okay, all these little actors are making their decisions. Let's just observe it. We're not going to try and direct it. There's a happy medium. Pure Keynesianism, pure Austrianism should never exist. They should be mixed together.
Right.
So
Well, so how do you observe on the small scale like that and collect, like, how do you get that kind of data set in order to actually analyze it and apply it to the whole?
yeah, so where a lot of like my data and statistics come from, especially when we're having conversations like this, is the Federal Reserve Economic Database is a pretty
Mm,
good homogenizer of data, and we're looking for a lot of data by proxy. That's the thing about macroeconomics; they're very hard to observe directly. So what we have to do is figure out proxy. So if we're curious about people's propensity to purchase a vehicle, what we'll look at is how the prices of vehicles change over time relative to some standard vehicle. Or we'll look at like how much somebody's willing to pay for a square footage of a home, like one individual square foot, and
mm-hmm.
then apply it over the economy as a whole. Now we can take that into the trading world, and one of the ways we do that is we look at something like the Magnificent Seven or something, and we see, well, a financial economist. I'd say actually if somebody who's more astute in finance than me. I really shouldn't say that I'm a CFO. I should be selling myself better. Sorry, just had a moment of realization. So we should really be looking. A trader can take that and say, how is the market trading versus the information they know.
Mm-hmm.
So, and that doesn't mean insider information or something like that. The market homogenizes information, and markets are incredibly efficient at information gathering. But how a trader breaks off from that can be using this proxy economic data. So if you think if you're somebody who wants to really heavily invest in, say, hydrocarbons, coming to understand, what's going on with Venezuela and Ghana in Essequibo. Okay, like, hey, Essequibo has about 60% of the oil, 60% of this massive oil reserve that's just been found, and you're speculating on oil prices, and if Venezuela's like, hey, we just voted to annex this. Well, what does that mean for oil prices down there? Well, somebody may say, oh, that's really bad. That instability in government contracts is a bad thing. But wouldn't that make oil more valuable because you just reduced and assumed supply? So that may actually make somebody take a bull position where a lot of people may be more hawkish on oil because hawkish, instability leads to hawkish and bearish scenarios. And that's on individual research. So a lot of macroeconomics is taking that data that we'll see from like the Federal Reserve Economic Database, Bureau of Labor Statistics, the IMF, and all those data sets, but then applying like a good, robust understanding of everything from like geopolitics to even occasionally like science will work in there. Like helium we're having a hard time getting helium. Well,
Yeah.
helium you need to make fiber optics. You get fiber optics need to be made in a pure helium environment. And it's like, oh, what does that mean? Does that mean, oh, now that we're seeing declines in helium, does that mean, fiber optic companies, do you bet on the companies that make fiber optics being able to charge more? We call that PPI, Producer Price Index, which is another metric on Fred.
Mm-hmm.
Or are we like, do we become really bearish on stock like, Xfinity and other stocks like that, since their prices are going to go up, but, pressure from streaming services are going to suppress their ability to fluctuate upwards. And that's where macroeconomics becomes useful to trader. Most traders I know love talking about macroeconomics. They're usually like wicked well versed in it. Like I'll tell you, like they're way more well versed than the general population because they like this discussion. Nobody gets into trading because they're boring.
Right. Exactly.
Like, nobody gets into trading because they wake up every day and want to eat the same Cheerios. Like they get in there because they like having panic attacks and drinking too much coffee.
Yeah, pretty much.
Yeah.
Minus the coffee, but yeah.
Yeah, as a pound and a Dunkin' Donuts at 8 o'clock.
Yeah.
At night. The true New Englander, right?
Yeah.
So, yeah, I think one of the things I'd like to lead off, Kyle and Mr. Banks, is talk about GDP. GDP is it's one of those things. The stock market's not the economy, and the economy is not the stock market. But man, GDP makes people feel good. It does. You don't run and invest when GDP declines. So yeah, I kind of want to start off with the big foundation, that stat we hear all the time: GDP, gross domestic product.
Mm-hmm.
And some of the questions that I get at my job, and some of the questions when I go to speaking engagements and do Q&As, really focus on GDP, and I often find it a weird discussion, to be honest with you.
Why is that?
Because I don't think it matters to the stock market that much. I think it matters if the numbers are going up or down, but I don't think it matters to individual stocks. Because I ask people this all the time: how often do you think of GDP?
Like when the numbers come out, maybe?
Yeah, right. Like,
yeah, that or the news when it pops.
Right. You hear it in the news. And who's presenting it to you in the news? Is it my lanky ass sitting behind the counter?
Nope.
No, not usually.
No, it's probably like a communications journalist major who's probably wicked smart and smarter than me. But I'm just guessing they probably have never taken an econ course. They see some number go up and they're like, oh, nice. What do you look at more, GDP, or do you look more at your trading account?
Probably more at the account.
Yeah, the account.
Obviously, yeah.
Yeah, because that's what matters more. That's not
Right.
irrational. Like GDP is a cool statistic. It makes people feel good about themselves. But what makes up GDP is it's consumption, investment, government expenditures, net exports. That's all. That's all it's made up of. And so one of the questions that often gets asked is, you want to drive GDP, and what do we do when we want to drive GDP? We will just print a bunch of stimulus checks or something like that. That has nothing to do with driving long term GDP growth.
Right.
All the body of information, Nobel Prize winning model, solar growth, the Swan solar growth model, which I feel wicked bad for Dr. Swan. Everybody calls it a solar growth model. And like all kudos to Robert Solow, deserves it. But it's the Solo Swan model. Like he also thought of this. It's the most important model probably made in the last 60 years. And it's just so much easier to say the word solo. Like this dude, I feel gets completely clipped out of the the allure because like nobody wants to say swan.
Right.
And what that tells us is capital accumulation has to outpace capital depreciation in the economy for it to grow. You need to have more capital coming in your economy than you're losing it. Real simple. If your car keeps breaking down, you can't afford to repair it. You have a shitty car. You have a shitty economy if that's happening too.
Yeah.
Oh, that's a good way of thinking of it.
Yeah.
Yeah.
Government expenditure doesn't drive economic growth. Consumption doesn't drive economic growth. And net exports, you can get net exports gets a little hinky because yes, it doesn't drive growth, but you need foreign direct investment or FDI into a country, and investments a form of capital can drive long-term economic growth. So I don't really want to jump in there. I don't want to fully dismiss exports, but it's the underlying investment in there that matters. So when those stats come out, I always tell people like, no, go on Fred, look up what grew. If it was like a 3% growth in capital and investment, banger. That's a good sign. You should, as a trader, if you start seeing investment growing, that's an excellent indicator that the overall economy is turning positive. It's that people unilaterally are pushing more money into the economy. If it's all consumption based, well, you can only spend $1 once. A bank can invest, with fractional banking, they only need to hold 10% of their actual liquidity in the United States. That dollar can be spent 10 times, and then somebody can spend that dollar over and over again. We call that the multiplier effect. So that's really, really strong and robust. So you want to see more investment. If you see the economy grow because of government expenditures, you should run away. You should be terrified of the market. If it's a 4% GDP growth and of that, it's made up solely of government expenditures, that represents either you're going to have government expenditures has a crowding out effect. Government has to borrow money to spend it. That causes less money to be available in the economy. So now you can charge higher interest rates because there's less actual number of dollars to be borrowed. So that can make the bond market. So if you're a trader and you're like, you're kind of feeling uncertain, and you see that large government expenditure go up, like we've had in the last couple of years, you might be like, ooh, government bonds might be a good move, might be a good way to balance my portfolio. Instead of holding in cash, let me take that, government-backed bonds and start buying those. And that's why we're seeing higher treasury bills right now. So it's these little, you're never going to find, like, you're not going to hear from me. I'm sure, like, Mr. Banks, Kyle can tell you, like, a way better, like, home run hitter or something like that. Like, you're never going to get a good stock pick from me. I'm the boringest dude in the world when it comes to investment. What you're going to get is these little kernels, these little jigsaw pieces that you can then put together because you understand what these basics are. And the best way to start there is GDP.
Can we go back to the government expenditures then for a second? So, like, are you talking about like even like infrastructure spending? Like when we go and like do road repairs and like dump a bunch of money into that, that's not good for the economy necessarily?
So it's not whether it's good or bad for the economy. It's whether or not it's as efficient as private investment. So
Gotcha.
Something like roads, and I've spent about $250 million on roads in my career, my job. It's good because roads have a IRR of about 1.5%. Maybe
IRR?
Yeah, IRR. Did I say ERA?
No, what does that mean though?
Oh, sorry. Internal rate of return.
Gotcha.
So basically, take your time zero negative, your cash flow out, so you're negative, and then all the return. So it's not, the market will never build something that's that's 2% return, 1.5%. That'd be really weird to take on the risk of that. So that's a good example. That's why I'm not a pure Austrian, because I'm like, hey, this is great. We should build roads. We should build airports. We should protect free navigation of sea travel.
Mm-hmm.
So when you see that type of investment going up, that's really good, Cal. So that's a good call right there.
Okay.
When you see like large scale deficit spending for social programming,
yeah, like when the stimulus checks are going out during COVID, that kind of thing.
Yeah, I got a stimulus check, and I was like, I
Yeah.
worked right through COVID. I had
Yeah, same
very
here.
gainful employment. I was like, why am I getting this? I was like, why am
About the same thing. I still cashed it.
yeah, right. Because like, but that's where like that's where I become an Austrian, because I'm like, yeah, you should cash it.
Mm-hmm.
You should. You're disadvantaged if you don't.
Yeah.
But when you're doing $3 trillion, $2 trillion deficits year over year, and you can have deficits are different. All right, like a federal deficit's much, especially in the U.S., is much different than like your deficit, being negative on a margin, or your personal budget being negative.
Mm-hmm.
If you are running up national debt, but it's slower than your GDP growth, and you're pumping it into infrastructure investment, that's a good investment. You're basically borrowing on your money at a lower rate of return. I'm sorry, lower rate of interest than you are getting in the return if your GDP is growing faster than your borrowing costs. I don't think we're seeing that now. And by I don't think we're seeing that, I mean like the math is not showing that. This is not brilliant Eric Mason coming up with new mathematical formulas. This is a pretty normal fourth grade division. So that can lead government to either have to tax more in the future, or it can lead to kind of an interesting scenario where they're bonding more, and they're just sucking the dollars out of the economy. I mean, because the bond, listen, this is a show for traders. Don't get me wrong, but like the bond market's so much bigger. The debt market is just so much bigger than the stock market. It pulls the stock market sometimes. So it's important for traders to understand these kind of like fundamental functions and foundations that can, that maybe off their radar, and they could end up being on the bad side of a trade because they're not seeing this, this piling up of, government deficits that could come in there and pull away some of that marginal return and honestly hurt some of their risk portfolios.
So, like, how does the bond market draw on it like that? Is it just because it's pulling capital away from stock investments when it becomes more?
Yeah, so that's what happens, Kyle. So that's a big thing. It's there's a short term and there's a long term effect. The short term is exactly what you said. It pulls cash out, it pulls liquidity. That can really pinch businesses' ability to operate. Higher interest rates means it's more expensive for the business to operate, more expensive for the business to grow. Because when you're betting on a business, like you put in that trade in, you don't want the business to stay the same, right? That's not the goal here. You want it to grow.
Yep.
Yeah.
And businesses grow the same way an economy grows. Increased capital investment, right? Now you can increase that capital investment through retained earnings or through going out and get more partners for it or through bonding. And when the big U.S. government is sucking up all that bonding capacity in the market, that can hurt a business's ability to grow. And then what you end up happening is that if you're a trader and you're speculating on a growth stock, you're like, this company does something awesome, I can't wait to invest in them. Well, they're a higher credit risk profile. So because they're a higher credit risk profile, that means they're going to disproportionately feel the impact of government crowding out because their interest rates are going to climb disproportionately higher.
Right.
In macroeconomics, we have something called the ISLM model, which is investment savings / labor market. So you can basically come up with something called long run aggregate supply, which is, again, like I told you, economists love just coming up with acronyms.
A lot of acronyms.
Yeah, I've noticed that.
Long run aggregate supply is GDP.
Wait,
Okay.
say that again.
Long run aggregate supply, which is what the investment savings and labor market model has helps you calculate, is GDP. There's literally nothing different. I remember sitting in class one day just being like, hey, real quick, so why do we call it long run aggregate supply? And they're like, well, it's the supply of the economy long run. I was like, yeah, but it's GDP. They're like, yes.
Okay.
But we just added another acronym for. I've never heard
For
long
no
run
reason.
supply for no reason. And I was like, this is why people don't like us.
Yeah.
I'm just being honest here. I just think this is why people don't like us. The amount of shit that gets that I will take sometimes, and I just love it. Like after I'll do a show or something like that, especially like especially if I'm not even on a podcast, but if I do like a keynote and stuff, and I'll see some of the comments afterwards on YouTube, which you should not read.
No.
Just hilarious. I'm like, you know what? I am a piece of shit. I do agree with that. But yeah, it's so really what dictates that is you have one side, which is the investment in savings. So basically it says the higher the interest rates, you drive more investments. So people are likely to save more. But the higher the interest rate means the less likely somebody is going to pull resources from the savings market to use for capital because it has a higher interest rate, right? It costs more to take. then there's a labor market. So every first Friday of the month, people like me get way too excited because we get to see the labor market numbers, and we had a great January. I don't know when this is going out, but
Probably be going out Thursday.
oh, good. Okay, good.
Yeah,
Semi
timely.
updated. Yes, very. So the labor numbers came in fantastic. I mean, double what was expected. I think we were expecting like 175,000 new jobs. We got like 355 somewhere. I mean, this will be actually by the time Thursday comes out, they'll probably have already adjusted the numbers. Unemployment was just super low. It's staying low. The U.S. economy is wild, man. Like, we are the most developed economy in the world, and our unemployment rate is just so low all the time. Like, that doesn't happen in developed worlds. It's awesome. So those numbers are important to watch.
Can you give an example of what's typical then for other developed nations?
So you're looking like the Eurozone. I don't want you to say the EU, but you look like the EU plus common market.
Mm-hmm.
If you're under 6%, you're considered doing excellent. The U.S. is in the threes. We've been in the threes for a long ass time.
Huh.
And on top of that, when we just talk about unemployment, unemployment rate there's a misnomer. The unemployment rate's the number of people unemployed. It's not. It's the number of people in the labor force who can't find a job but want one.
Right.
In the labor force right now in the U.S. is about 54%, 56%. And then that changes largely from state to state, don't get me wrong. We've never really recovered from the 2008 recession. Prior to the 2008 recession, we were like upper 50s, lower 60s. I don't know if we'll recover. I don't really think that. I think there's an age factor to it also, to be honest.
Yes.
Like, people are aging out. I think we're seeing like that the demographic hump from the boomers.
From the baby boomers.
Yeah. So
Yeah.
I don't think a president can fix that. I don't think a president can really do anything on the economy, to be honest. But the unemployment rate, there's three types of unemployment. And if you're somebody who part of your investment strategy is looking at macroeconomic data and you see unemployment move, there's a methodical way to understand that and make it usable for trading.
Mm-hmm.
So the first statistic you need to look at if you see unemployment rate is labor force participation rate. Right? So if you look at that and it went down 1%, if labor force participation rate goes down 1%, that will make unemployment go down, even if the same number of people are working and the same number of people looking for jobs. That's because just the number of people who are in the labor force has dropped.
Yes. Okay.
Yeah. So the next step is to look at there are three types of unemployment. All right, and only one of them matters. So there's functional. So there's functional or frictional, depending on like where you went to school. Sometimes it's called functional unemployment. Sometimes it's called frictional unemployment. The technical book term is frictional unemployment. But if you read, I just want to make a point of it that if you read certain publications and you see the word functional unemployment, they're talking about frictional unemployment. I swear somebody scribbled that word weird one time.
If it's my resume, it's probably fictional employment.
Fictional. I like fictional employment. I like that a lot. That's a good one. I like that, Kyle. Sorry. So frictional unemployment is you don't worry about it. That is well qualified, highly educated professionals choosing not to work and waiting to select the right job. That's like if a doctor's out of work or a high-end engineer is out of work.
They're not taking a job at McDonald's just to get a job. They're waiting for something that fits what they're looking for.
Exactly, Kyle. Then there's structural unemployment. Those are individuals whose skill set's no longer applicable for wage generation in the economy. That's where a lot of governments come and retrain people. And they are actually, if you're somebody who's interested in public policy, they can be a quite expensive group to retrain. It's certainly worth the retraining, especially if you look at how young they are. We are saying with the modernity of computer programming and stuff like that, or I should say computers in the workforce, that's becoming less and less expensive to operate. I mean, it's hard to train somebody from a typewriter to being a machinist. It's not hard to train somebody who's like, oh, I kind of know Excel to here's how R works or something like that. So
right, okay, the gap isn't as big as it used to be.
Yeah, exactly.
Yeah.
The one that's important and the one that can cause negative GDP growth that can really spill over into the stock market is cyclical unemployment. And that comes from the word business cycle. And that's what we're seeing right now in kind of, tech town. We're seeing Silicon Valley. We're seeing this cyclical unemployment where, as these companies who overinflated their staff, especially during the pandemic, are now trying to bleed off some of that staff. That can flood the labor market. When that floods the labor market, wages suppress. And when wages suppress, people spend less money, people invest less. and you can start seeing that affecting the underlying value of equities you may hold.
So that's what cyclical means. I always thought it meant like the seasonals, like the people who come in to like pick fruit, like for the summer harvest.
Yeah, that's part of cyclical unemployment. Yeah, it's a
Okay.
big
Yeah.
anything seasonal or cyclical.
So,
It's
but even who like Activision, Microsoft just laid off like 1,900 people, so like that would be considered part of that too. That
yeah,
bucket.
and that would be a type of cyclical unemployment. That's part of the business cycle. How companies rise and fall, rise and fall.
Gotcha.
Even
Yeah.
interesting. Even Jeff Bezos talks about like he doesn't think Amazon will be around in like 50 years just because of business cycles.
So because of that, or he doesn't think he wants to run it for 50 years, and he
Yeah, I
can't
know.
survive without him.
Yeah, I often wonder like that freaks me out. Like how powerful, or not say powerful, like how influential certain CEOs are to running their companies. Like beyond economics, like that's kind of cool. Like you're that important to the company, but it's like, what does the company do without you? Are you the company, or is the company you? Like it's just
Right.
fascinating to me.
Like Musk.
Yeah, right. Like how he. I won't get in there.
Yeah, no.
I like the guy. I like the guy.
Pay
Some,
package. Yeah.
no, but it's how these weird kind of like you probably slept. A lot of kids who probably sleep through my class when I'm doing Econ 201. It's seeing that like kind of underlying interplay that can affect your portfolio and affect how you do trades. Because here, I'm going to give a really boring, overly economic like what trading is. A successful trade is just being smarter than the other guy you're playing against.
Mm-hmm.
It's a game. It's a game.
Yep.
That's economics. It's just a game. And you can be smarter than the person you're playing against simply by understanding these foundational effects, and these even starting as simple as like these foundational terms. This kind of like Kyle, when you brought this idea up, this is like kind of one of the first things I wanted to broach is like, how do we start not showing people, because I think a lot of the listeners know this inherently, but how do we give like a roadmap to what to look for? Because it can seem wicked overwhelming when you start off.
Yes.
It just seems really overwhelming.
Longtime fans of the show should be familiar with the lender formerly known as Sue Pullen, and I'm pleased to announce that she's back, fresh off a rebrand and ready to help as Sue Mackey. Sue is a certified mortgage advisor at Fairway Independent Mortgage, an equal housing lender who focuses on finding the right product for you and your needs. She has over 20 years of experience helping thousands of homeowners. Whether it's purchasing, refinancing, or even a reverse mortgage, Sue will help. Sue's licensed in 36 states now, so reach out and let Sue Mackey it happen for you. The best way to reach her is just give her a call at 520-977-7904 or in an email, spullen@fairwaymc.com. Fairway Independent Mortgage has an MLS number of 2289. Sue Mackey has an MLS number of 206048. That email again, spullen@fairwaymc.com, and that phone number is 520-977-7904. Shoot Sue an email and let her know she needs to update that address. So maybe we start there then. So we kind of talked about GDP and unemployment rates. I don't think we've touched on inflation quite yet, but so with GDP, like the main thing to watch for then is the government expenditures and where the actual money's coming in. Is it being driven from investing, or is it being driven from some other factor? And the one thing that we want to see is that people are spending money to purchase assets, right? Or to invest or to save or to...
Yeah, and another great stat to look at if you want to look at like long-term buyer's confidence or long-term investment, not just investment, but long-term value accumulation, is something called durable goods. So it's a wicked popular data series on Fred. And what a durable good is, it's a good that is going to last longer than a year. So this sounds really goofy, but this is honestly why I love Austrian economics. When people who are very bullish on the market, if people feel good about their back wallet, they buy refrigerators, they buy dishwashers, they buy stoves. They don't, because they think their future income, which people spend based on their future income, not how much money they have now, but how much money they're going to have in the future. If you're going out and buying that new Frigidaire dishwasher, you're probably feeling like your financial situation is pretty solid, which means you're going to be more active to, if you're investing in company, say you're investing in a retail company, they're going to be more, that means a larger portion of the population is going to be more interested in engaging with that stock, with that company that you own a stock in or you're taking a position in. So durable goods is another great statistic to follow. I'm a huge fan of durable goods. if you're looking for, I brought up bonds earlier, and we talked
Mhm.
about government expenditures and stuff. There's a data series called HQM, or High Quality Market Bonds, HQM bonds. And they have at the 1, 2, 3, 1, 2, 5, 10, and 20. I think they even have 30 years now. That's a whole data series. So if you're looking at that effect and you're trying to gauge it, if you start seeing some of those rates really start skyrocketing, and then you're looking at government expenditure at the same time, you're like, ooh, there's a wave coming. You might want to, like, don't invest in that bond. Don't, like, if you invest in that bond today and rates going up, your bond's going to lose value on paper. Uh, so yeah, there's all these like little interesting data series that we can really leverage that are outside just looking at traditional stock prices, that paint the picture on why these stock prices are moving and where they may move in the future.
So okay.
Yeah,
We've
that's
covered quite a bit of information here. So yeah, sorry, I was just going to ask you,
no,
Banks,
that's
if you had
fine.
any questions.
Yeah, I mean, yeah, I feel like I'm back in back in class. I'm taking notes over here.
I know, right?
That's scary. It's like, don't take notes of it.
No, but it's interesting because when you look at like last spring with all of the bank failures and stuff like that, um, it's hard to believe that a lot of these banks kind of fell, I guess victim to that, especially looking at the bottom line with where bonds were. And especially where rates were at that time. I mean, we dropped, I think it was like it was a 2-3% just on the Fed funds to go to zero basically during COVID.
Mhm.
And and then just after that, I mean, it just seems like everyone just kind of missed the boat on exactly where rates were going to go in the future. And you're starting to see it now. I mean, I just saw another bank was having trouble last week.
Yeah,
So
saw that too.
it's super intriguing, just your kind of view of it. And I never even thought about looking at like durable goods and stuff like that as like an indicator.
Yeah, I mean the bank failings were interesting. They were weird because their asset sheets, the asset sheets were strong. They were just
Yeah.
all in liquid. Mr. Banks, you hit it right on the head. All these guys were loving these low rates and that renewal series, and then they were like, they end up buying these really heavy assets because they were like, really in liquid assets, because they were like, oh, money's going to be cheap forever. It's going to be cheap forever, cheap forever, and it disappeared. The interest rate went up, so
Yep.
all their
Mhm.
asset values, because it's a fixed coupon rate, crashed down, and suddenly a bank goes from being 150% funded, assets to liabilities, assets to holdings, and suddenly they're 75% funded. Not because anybody took money and moved it, but because they didn't call the market right. Back on December, so it was December 14th of 2021. The city I'm CFO for, we sold a pension obligation bond. We sold $500 million. It was one of the largest ones in U.S. history. We sold for 2.62%. The
Mhm.
market gave us $500 million at 2.62%, and rates immediately climbed the next month. I looked like Nostradamus. I got calls from like people all over. Wow, that was really smart. I spoke at the World Finance Forum. I had an op-ed in the Hill. All this cool stuff, and I'm sitting there going like, I was just like, oh, the rates are low. I think rates will be higher in the future. End of thought process. And now that $500 million with no risk could be invested in fixed incomes right now and get double the return that I'm paying 2.62% on. Like, it's strange that, like, I sit there and go, I often wonder, like, when these banks, especially smaller banks, I think when you get to like huge banks like JPM and stuff like that, like, there's too many people who know what they're doing, where it's just like the intelligence of the masses. I wonder what some of these small banks, and this is where like a lot of traders who do their homework, like their Warren Buffett-esque homework on the companies themselves. I'd love to see a stat where how active traders played that off, because I got to believe the well-informed active trader probably saw that coming from a mile away. They're like, your long-term asset sheet keeps growing, and we're in we're position right now. Like, mathematically, how I looked at doing our pension obligation bond was, I was like, well, rates are at these all-time low. They're comically lows. So what's the percentage rate's going to go up? And mathematically, it means there's a 99+% chance rates will go up. They can't go any lower.
Mean reversion kind of idea.
Yeah,
Yeah.
and people think it's just like brilliant. They look at me like, oh, it's regression discontinuity. Is this I presented to the city council like an RDD, regression discontinuity design, and a difference of difference model to kind of illustrate what the effects would be. But on top of that, sometimes, economists, we like to make things more wordy and complicated. We like to show off that we took one calculus course in our entire lives. In this case, it was just simple, arithmetic. Like, it has to go up. It can't go. We can't. We're not going to have negative interest rates. We're not Europe. Like, the U.S. will never have negative interest rates. It's so illogical. Like they'll destroy the underlying U.S. economy, not the U.S. the global economy. Then I'm sitting there going, we can't go any lower, man. Just take it out now.
Right.
And it's saved the city $186 million. That's great. That's $186 million I would have paid in I would have had to pay in interest expense over that time, or in most cases probably underperformance. Like if the pension fund underperforms, cities have to put money in to make up that performance shortfall. But because we took all the money up front, or we borrowed all the money and put it in up front, like those performance shortfall markers don't occur anymore because you incurred that cost when you issued the bond. So yeah, I mean, like a part of me is like I made the joke like, hey, I'm a very boring trader, and I certainly am. But all this stuff I'm talking about is not. I'm not just talking about theoretically. Like these are things that we use in decision making every day. That I use in decision making every day. I just don't have my pension fund in options. God, I hope I don't actually. I gotta check that. I'm gonna call my advisor.
So
it's not anybody listening. It's not very properly invested with Prim and Makita, who are excellent. Like, just want to throw that out there.
So we've talked quite a bit about like some of these different indicators like GDP and unemployment rates. Like, so what are some of the other ones that maybe we as traders should be a little more versed in or should pay a little more attention to?
Yeah, one of the ones I really like is kind of like that next level of statistics, and I kind of touched on it a little bit when I was mentioning like high quality market bonds. I really think following the bond market is a really important way to keep looking at this. But bond markets are a little strange because everybody talks about bond markets as they kind of look at them as static, like bonds don't change. And even like my specialty is municipal debt. I've done about $2 billion worth of municipal borrowings, and they're not bonds trade. Even municipal bonds, the boringest of all bonds that are tax free, they trade about once a year. So even though it's a 20-year bond, it's going to trade 30 or 40 times in its life. So if you're looking at data series that have to do with kind of addressing long run potential shortfalls in your strategy, I really do think that anything involving keeping an eye on the bond market can certainly help. The other one I always look for is allowance for loans and lease losses, or ALLL, which is a horrible
Another acronym.
Yeah.
Nice.
Yeah. what this monitors is how hawkish, or I should say dovish, hawkish or dovish, banks are. And what banks basically have to show their cards. Like that's my thing. It's like, because of government reporting, a trader can like go look at what like JPM thinks. Like you can read through all JPM you want, and they're never going to tell you everything. And JPM's like was a great partner. They were part of our pension obligation bond. Like JPM's awesome. Like they deserve all like the love they get when it comes to like just how smart the people who work there are. But you can aggregate all that data, because at the end of the day, if you're a trader, you shouldn't care what one bank thinks. You should care, but you should absolutely care what every bank thinks. And what ALLL allows you to do is see the entire thought of the banking market. So if banks are putting more money on their balance sheet aside because they think that there's going to be more defaults and there's going to be more losses from the money they're lending out, that means there could be an economically turbulent time that's coming ahead.
Right.
And so that's always one of those really good early indicators. Like, all right, what kind of like what's going on over there. The other one is I'm going to be real basic. I'm a real basic person here. CPI, man, Consumer Price Index is. Yeah, Consumer Price Index is. It's just important to follow because it represents. Yes, does it represent how much prices are changing over time? Absolutely. Do I think it's one of the worst statistics of all time for measuring price change over time? Yes, I do. But does it tell you how people are going to react? Oh, yeah, it does. Yeah, it does. Like when CPI climbs, even though most people have no idea what makes up CPI, we could certainly talk about that.
I've tried looking into it before. My eyes started glazing over. But
yeah,
I've dug into it a few times.
Yeah, I swear we made that complicated for no good reason. Like, it's like, oh, hey, what's the it's how prices change over time, but don't count food and gasoline. What?
And also, rents will be kind of done in a weird like delay too.
Oh, Yeah, it's like, yeah, I don't want you to count housing, food, and food for your car. It's like, what are we counting?
Those are like some of the biggest expenses.
Yeah, it's like 80% of your budget doesn't matter. It's like,
Yeah.
No, so like, but here's the cool thing, and this is my advice I always give. So they do record CPI with all those things included. They include CPI for like meals outside of your house. Like if you're if you're a trader and you're going to invest in restaurant, or you want to invest in stocks like Yum and stuff like that, you can actually see how much the price index is changing over time for food, dining services outside of a house.
Right.
Like and you can even do that in metropolitan statistical areas. So if you're a trader who's like, do you know what, I want to start investing, like say you want to start a restaurant, you can actually look up that exact data for your MSA. But here, forget about everything. Everything with like hard quantitative economics. This is going to be pure macro side stuff on CPI. People react to that statistic more passionately than I've ever seen people act to a statistic. And it's fine. I get it, because if somebody tells you something's more expensive, that's going to piss you off, especially if it's something that you don't have an option on having housing or eating or driving a car. Like it sucks to see your money worth less. Like that's a really valid concern. Like we shouldn't dismiss that. Like they're pissed off for a good reason. And that type of consumer sentiment can bleed over into the stock market. I would argue that it does bleed over the stock market 100 out of 100 times. So an investor may be more challenged if they don't know what that data looks like.
Mm-hmm.
But yeah, I mean, I see these stats all the time. They're like, oh, a car in 1930 compared to today would only be $8,000. And I'm like, I had a great economist professor who I love him. He's like literally my mentor. We've worked together. Like he's awesome. And he said to me one time, he goes, you can't compare a car in 1930 to a car today because there's literally things that weren't invented in 1930 that are in your car today.
Right.
And how do you price those in? And I'm like,
also,
yeah,
there's a
right.
lot of safety factors and other things that weren't required then, like seatbelts and airbags.
So I will tell you, my dad has so my father's mechanic, his father's mechanic. My family's like mechanics all the way back to when cars were first came about. And so we have a 1930 Model A, and it has nothing in it that my Blazer has, except it has shades and it has curtains in the back. Which I was really upset those have gone away. It's like,
I do remember those.
Yeah, because they're trying to like mimic like the horse-drawn carriage, right?
Yeah,
yeah.
I thought that was really cool. That was $800 in 1930
And you can have it any color you wanted, as long as it was black, right?
As long as it's black. Though they put a pinstripe on this one, so it must have been a fancy one. It's deluxe edition. Also, baller move buying in 1930, given the Great Depression, the deluxe version of the Model A.
I know.
Like baller move. Like, who was this person?
Rockefeller.
Yeah, right. Yeah, so like when we talk about inflation over the long run, it's really actually super difficult to compare over time. Even and the more advanced technology gets, the harder and harder it is to compare. Comparing 1900 to 1920 for inflation is much easier than comparing 2000 to 2020. Because think about all the crazy technology. I mean, look at us. We're doing a Zoom call or Riverside. We're like podcasting. We're in all different time zones. Like, this is crazy. Think how more efficient humans are now. Like, if I was in 2000 and I was trying to be like, yeah, I'm going to have this laptop that's hooked up to this, repeating electromagnetic signal that's going to be on this little node inside your house. And I'm going to be able to talk to people on the other side of the country. They'd be like, yeah, that's going to be $90 million. And like, I think we're doing that now for like pennies a day to like be able to produce this stuff.
2000, I was still using an encyclopedia to write reports.
So a little color in Eric's personal life. Growing up, and this should come as no shock to anybody here, that I used to just read encyclopedias. I thought they were the most interesting thing.
I used to love reading my history book.
Oh right, like
that's cool. Such a nerd.
So my dad, who's like the best dad in the world, he was really like, oh, I'm not like, he wasn't big on the internet. Guy still has a flip phone, and so
nice.
He just bought the Encyclopedia Britannica, like the 8-disc set, and I used to put it in my computer just to read through it, just like. And my parents had me tested twice. Both times came back negative, and as my brother always tells me, if you get tested twice, that's the same thing as one positive.
That means they didn't believe the results.
Yeah, there we go.
I get a second opinion here.
Yeah, right. No, but the thing about like technological advancement, and I think there's a real cool parallel here to trading, because what traders are speculative by nature, I believe. And trust me, you guys disagree with me on that. I'm not saying that's like the end all be all, but I think they're inherently a speculative nature to trading.
Yeah.
So if you're somebody who is heavy on the speculation side of trading, it's important to understand that if you're trying to line up that timeline or line up that continuum of advancement, which is what you should be doing if you're trying to speculate, um, it's important to remember that that spectrum really seems to be increasing in speed. So taking that trend line from before and just applying it, linearly, has shown to be wrong. I mean, it's shown to be wrong. That's one of the coolest things about capitalism, is that capitalism is able to implicitly express a demand before it's explicitly stated. It's able to come up with a car when nobody knew what a car was. It's able to come up with an iPhone before anybody knew what an iPhone, because capitalism is a beautiful system that really allows us to, combine different ideas and wants and create demand that the market can meet at some point. So speculation is actually, I think, super important. But as you're doing it, it's kind of trying to predict, the next car or the next iPhone, which, God love you guys, I have no idea how people do that. That's far beyond my capabilities.
All right, we're about 50 minutes into it. I think we've covered most of the main topics here. Do we have any questions or any follow-ups that we want to ask here, Banks?
Yeah, well, I mean, which I don't know if we'll dig into it in the future, but like my main question with macroeconomics is, like, how do you devise a trading plan for a daily basis?
So some of the things that, talking to different people, and like, I'm very fortunate to exist at this intersection of economics and finance. That's one of the things I love about my job, but I love about my academic background. Reporting cycles. I always tell people that, like, in economics, we believe people make decisions based on the information they know, and they try and do that as rationally as they can. So, what I suggest to a lot of people is come up when you devise a strategy, right? And you're like, you know what, I want a certain level of risk factor. I want us to target a certain market. I want to target the tech market. Come up with a data release calendar. So as you explore this and better understand what each statistic matters in your trading life, I'm going to focus on the tech sector. So I'm going to look at, you can have durable goods for technology. I'm going to look at unemployment rates that have to do with the tech sector. I'm going to look at advanced degrees and stuff like that in the market. How well is somebody with a master's degree doing? Put that on your calendar, and you should be trying to negotiate your trades based on these. We call them discontinuities, or it's like the day before information is released and the day after information is released. The day of information release would be the discontinuity. That would be that line in the middle of the graph. And you should have a strategy. If this number appears above expectation, below expectation, or hits your baseline, what you're expecting, what would you do next? And once you combine those together over, say, the course of a year with those different information releases, you can work that into your underlying strategy. You can bring economics into your plan by understanding what these underlying statistics mean, these underlying data series, but also building your strategy based on hitting those different marks. I equate it to a lot like navigation. You hit your waypoint, do you go left or right? Next waypoint, left or right? And combining those statistics together and combining that analysis and that thought process together, you can really build that into a strategy.
Okay, that makes sense.
You kind of walked us through something with like Boeing that I think you did kind of similar line of thinking, and actually kind of timely because they just had some more issues with doors opening up mid-flight and other things.
Yeah,
missing bolts and wings and stuff like that.
Yeah, so I'm an aviation nerd, like horrible. Like my poor wife, but I'm a horrible aviation nerd. Like I've been to Delta and I flew in their like full simulator for the 737. Like,
cool.
Like a little cockpit and it moves up and down and stuff like that. I only crashed once, which I was told is bad. I was told that was not good. So,
not supposed to do that.
Yeah, crashing once is really a ender. So one of the and I think we talked about this maybe like a year or so ago. One of the ways I've applied this, just cards on the table, and I'm happy to share. I have an Excel sheet with this in here. Obviously, it's not trading advice. Well, what I went back and did was I looked at every single Boeing incident over the last 30 years. I think it was like the last 30 years, maybe the last like 24 years or something like that. Mm-hmm. And every time there was an accident, I ran an RDD, which regression discontinuity design. It's the most advanced version of econometric analysis we have that still has a hypothesis test, which is a really fancy way of saying we know whether or not the effects were real. And what I found is that after every Boeing incident, the stock price went up. It would come down, people would overreact, and then people would outbuy in the market and would go back up. And it actually just happened with that. And, there's two ways to take this approach. You can take the pure mathematical trading approach, is what I recommend. And then you can go way off, way off your normal, what any normal rational person with, free time should do, which is like what I did, which is like, it's not just the stock and analyzing it, but it's about analyzing the underlying, what's going on with these planes. And at the end of the day, like, first off, the fact that a plane lost its plug is crazy, and it landed is amazing. That's like,
right?
Yeah. Funnier story is that version of the Max is super uncommon in the U.S. because the reason that door plug exists is because you need to have, the plane rolls off the factory line. It needs to have a certain number of doors in there because you need to be able to. The FAA says you have to be able to evacuate the entire plane within 90 seconds. A lot of these planes have less seats on them, or it's like the shorter series, like the 8 series, and there's not enough people on there to justify an extra set of doors, but you're not going to change the whole production process of these super advanced aircraft. So you just put a door plug in, and it should be fine, except when you have bad bolts. Don't materialize that. The same thing with what happened with the MCAS system in Boeing's plane, when we had the Boeing crashes. So that system, give me, if it's okay, just 90-second explanation on why Boeing Maxes were falling out of the sky. So the FAA for certain aircraft types allow self-certification for safety, and that sounds really crazy. Like, why would you allow that? It's because planes can make these small 1 or 2% changes and have massive efficiency gains. All right.
Mm-hmm.
So what Boeing, if you look at the Max, so Boeing 737 has been around since the 60s. Right. You had the Boeing -200 series. Great planes. Some of them are still flying as freighters. I mean, really robust planes. In order for a plane to get more efficient, planes have a certain maximum efficiency they can do, right? Because a plane can't fly really fast. If a plane starts flying fast in 650 miles an hour, it enters this thing called transonic flight, and it becomes really high turbulent. You actually lose a lot of fuel efficiency because of the way the wings go up and down.
A lot more friction and other things too.
Yeah, exactly. Because what you start seeing is little points on the plane, along the plane's wing, will start experiencing supersonic flight. Or sorry, not supersonic flight, but supersonic airflow. And that creates a wobble effect. So planes have actually been getting slower since the 60s flying. Like the MD-8 was far faster than pretty much anything flying today. So you need to get these efficiency gains and fuel savings, right? You can't get there faster. You got to get there more efficiently. So what do? You come up with these things called high bypass engines. So if you look at that giant fan that's on a Boeing, so like the engine cowling on a Boeing, you'll see it's a huge fan right there, right? All right, only a very small part in the middle is the actual jet engine, and all the other air flows around it. And what we basically, that's called your bypass ratio. For every 1 cubic foot of air, cubic meter of air that goes through the engine, how many cubic meters of air go around it? The new Boeing engines on the Max series, I think it's like 11-1, 15-1, super efficient, right? Now, if you look at Boeing 737-800, all right, so like the NG models, the new generation models, you'll see they're very circular, all right, where the engine sits. And if you look at the Max series, you'll see it's actually flat at the bottom. That's because the fan blades are getting so big, you can't even stick them underneath their wings. Yeah. So in order to house that engine, what Boeing had to do was to push the engine slightly further in the wing. Now, if you think of a plane's perfectly balanced, you move some weight forward, your nose goes down. So they had this thing called the MCAS system. And what the MCAS system did is it basically had a sensor on the wing that if the angle of attack or, what direction the plane's flying relative to its axis started going down too negative, the plane would correct it. It would correct it. All right. Now, Boeing, and this is where Boeing did something that, I don't think was the smartest thing to do. Boeing had one sensor on the plane. All right. But they had the option to have two sensors, one on each wing. I think maybe it was one on the nose, one on one wing, as a redundancy. Everything in planes should have a redundancy. Yes. So if you notice, a lot of these plane crashes were Malaysia, Ethiopia, were in developing countries where they were in the global south, and those airliners only had the base model MCAS. And what was happening is that the plane thought it was falling, so it kept pushing its nose back up. Boeing had an issue with Boeing's programming, had kind of this weird system. And this is where it gets in the gray area. And I think a lot of the investigations were like, could it be overridden? Could it not have been overridden? But if your plane keeps trying to buck you up 20 degrees, that's hard for a pilot. I'm not I can handle that.
That's terrifying.
But in the U.S., every Boeing had both sensors. It had the redundancy. That's why these accidents happen at Boeing. So after these horrible crashes, a lot of people made a lot of money. If you look at the option books at that time, because they knew that they were like, "Oh, the FAA is going to put these are going to come back in,
going right back in the air." Yeah,
right back in the air. And that same thing's happening right now with the Max series. There's not that many of them, so people applied all that negative to the entire Boeing fleet. And Boeing 787, the Boeing 777 are excellent aircrafts. But they applied that to everybody. And when they applied that to the whole entire Boeing market, they applied it to every single plane. Smart investors were like, whoa, this is only representing an incredibly small percentage of the Boeing fleet. So everybody liquefied their stocks. A lot of those guys did. A lot of option traders came in there. And I looked at the option books and made a ton of money because they were like, oh, whoa. I know this market good enough. Those planes don't exist in a large number you think you do. It's like hearing a Ferrari crashed and then selling Honda stock.
That
makes sense.
Yes.
Yeah, it's what's funny to me is that the other stories with Boeing, like Boeing 787s, the Dreamliner, one of the best planes ever made. The first wide body aircraft that's all pretty much all carbon fiber, super light. It uses the GE9X engine, like excellent aircraft. Its paint's falling off, which is like super bad. I mean, it's not like not gonna make the plane crash, but like there's all this litigation with all these companies about, dude, your paint's falling off. And I'm like, that's a bigger threat to your bottom line if your best selling plane. A Boeing 737 costs like 100 million, 120 million.
It's something ridiculous.
But a 787 is like $500 million. Like you have these like massive companies going into litigation who may go potentially into litigation over this paint. And then there was delays with the new engine, like the Trent 11 engine wasn't available. So like I'm like, no, that's a threat to the company. But I'm not gonna lie. Some obscure conversation from a nerd like me about bypass ratios on the GE9X versus the Trent 1011 pales in comparison to a fucking door blowing off the side of the plane. Like nobody wants to hear Eric talk about like how to be honest.
Yeah.
That was way more than 90 seconds, by the way.
Yeah, I know. It was like a 12-minute explanation on the history of Boeing in our economic series.
but just to loop it around, like that's the level of like insider knowledge that it's not just economics teaches you a lot of disciplines to like do that type of research, but it's these little kernels of data and truth that you can find that can give you such an advantage trading. Like it really is. It's wild to me.
It's really funny to me that when I came into this, I thought we were going to be learning about how to look at the big picture. But really what it sounds like what we're doing is we're taking the big picture that everyone's overreacting to, and we're digging into the real numbers to try to find what certain aspect of that is causing the big picture to look the way it does.
Yeah, no, and that's the beauty of economics. It's the eternal search for truth in a very goofy manner if it's coming from me.
Banks, you got any other questions here?
No, I just, I'm, of these other, things that we're going to talk about in this series, I'm super excited. God,
I know.
Yeah.
Yeah. Should I tease one of them before we wrap?
Oh, go for it.
All right. Well, yeah. So let's see. Next time we will be looking at government fiscal policies like taxation and spending, central bank monetary policies like interest rates and money supply, and how those influence the markets and how traders can interpret these moves. But I think that's probably going to do it for today's episode. So let me first say thank you to everyone joining tonight. Special thanks to the informal economist himself, Eric Mason, for putting this masterclass together. You can visit theinformaleconomist.com if you want to see more of his work. And if you have any questions about what's covered today, please send us an email, DM them to us on Twitter or Discord. And we'll make sure that we spend some time answering those in the next installment. Eric, are there any other resources that people can dig into if they want to look into some of the other concepts discussed today?
Yeah, absolutely. I think, obviously, I mentioned the Federal Reserve Economic Database a lot. I think that's a great resource to start if anything we discussed today interests you and you want to work it into your trading portfolio. And, as Kyle said, we're going to really evolve this even more as we go forward throughout this mini series. And the other one is a book I recommend every time I'm on a show, but it's particular to a lot of the concepts we talked about today, which is Niall Ferguson's A Scent of Money. And I also want to recommend a free digital book that has been out for a long time, but it's actually used in a lot of grad programs called Mixtape. If you just Google econometrics mixtape, you're going to find everything I talked about today: regression discontinuity design, diff and diff modeling. You're not only going to find a free resource that's a graduate level on it, it also walks you through how to do the math in all these different coding languages, and it's an excellent resource if anything here interested you. And aside from the other ways to contact me on my website that Kyle mentioned, my Twitter handle's Eric James Mason, because apparently I could actually get my entire full name. And like I said, feel free to DM me on there, but also feel free to talk mad shit to me, because I will not be able to respond.
I'm typing out a message right now.
Yeah, right?
Eric, you're a bitch.
Yeah, deep voiced asshole.
Stop smoking.
Animal from the Muppets trying to give economics.
Oh god. All right, we'll be back soon with another exciting episode, but until then, please smash that 5-star rating, tell your friends, and have a great day. This podcast is intended for informational and educational purposes only. It does not constitute financial or investment advice and should not be construed as such. The hosts, guests, and contributors of this podcast are not licensed financial advisors, brokers, or professionals. Any trading or investment decisions made based on the content of this podcast are solely at the listener's discretion and risk. Trading and investing in financial markets carry inherent risks, and past performance is not indicative of future results. Listeners should conduct their own research and seek advice from qualified financial professionals before making any financial decisions. The views, opinions, and information shared in this podcast are those of the individual contributors and do not necessarily reflect the views or policies of the podcast creators or associated organizations. Produced by China Shop Productions.